Everybody is worried about the C word, crash, in the stock market. That's why investors are so confused. People are wondering, okay, should I put my money in the market? But if I do, well, what happens if the market pulls back? And if I don't invest my money, then my money is just being eaten away by inflation because we saw 7% inflation in 2021, so my cash is doing nothing in the bank. So what do I do with my money? And it's the same with banks and investors and hedge funds on Wall Street. You have JP Morgan Chase Bank, one of the biggest banks in the world, one of the biggest banks on Wall Street, coming out and saying that we're going to see no stock market slowdown in 2022 and we're going to see the stock market boom in 2022. And then you have hedge funds on Wall Street saying the exact opposite. They are saying that they're worried about interest rate hikes, and because of that, they have been selling off their tech stocks at some of the fastest rates that we've seen. We're already seeing a whole bunch of volatility in the market. I mean, some days you hear the news talking about how the market is breaking a brand new high, and this is why you should be going in and buying. And it might be a great week. You see the market rallying and you see everything going up. But then the next week, the Federal Reserve Bank comes out, they start talking about interest rates, they start talking about a slowing economy, and then everything just comes down. It's a bloodbath. I pulled up the CNBC article talking about what's going on with tech stocks, and what they're saying is that tech stocks are sensitive to rising yields, meaning rising interest rates, because we know that the Fed wants to raise interest rates multiple times in 2022 and 2023. So it's saying that tech stocks are sensitive to rising yields because increased debt costs can hinder their growth and they can make future cash flows appear less valuable, and that's why we've been seeing the NASDAQ get hit hard in 2022. We're talking about tech companies and tech startups. The thing that is very important for tech companies is valuations. Evaluation is how much the company is worth, and the way these companies come up with their valuation is by looking at how many users they have. So they take a look at how many users they have, and then they apply a multiple to these users. Maybe they say each user is worth $20, or maybe each user is worth $100, or maybe each user is worth $500, and then they take the number of users, multiply it by the number, and that's how they get this value. So tech companies have been really great up until the early part of 2022 because, well, there's a lot of cheap money floating around. You had low interest rates, you had a lot of people with cash, maybe people got bailouts or stimulus checks, companies got bailouts, so there's a lot of money, dollars floating around, and they were looking for a place to put it. Well, if we focus in on kind of what we saw happen in 2020 and 2021, the world moved more and more digital. And so people were really excited about this tech movement and this digital movement, and a lot of money flowed into these tech stocks because everybody was spending more time on the internet and the world is moving more and more digital. That's just the way it is. I mean, Amazon is the world's leading retailer. Anybody who wants to buy something on the internet is gonna go to Amazon to buy it because Amazon is so efficient, Amazon makes it so easy, and Amazon Prime makes it deliver so fast to your house. So when you're in an environment where you have low interest rates, you have high inflation, the value of your dollar is going down, nobody wants to hold on to dollars. Nobody wants to save dollars, and nobody wants to invest into a company that has a smart savings plan that is making dollars. They want to invest in a company that could see a lot of potential growth because that's the only way that they can combat inflation, by taking on the higher risk and trying to see the higher growth with their money. And so now they're investing into companies, which is driving up the valuation of these tech stocks, which brings me to the topic of value and valuations, because at the end of the day, when you are investing into a stock, you're not just investing into a ticker symbol. Like when you invest in Amazon, you're not investing in AMZN, you're investing in the Amazon Corporation. You're investing in the infrastructure that Amazon has built, you're investing into the warehouses that Amazon has built, you're investing into the real estate that they own, you're investing into the employees that they have trained, you're investing into all of that. That's what you're investing in. You're not just buying a ticker symbol, and that's what a lot of people assume that they're doing when they're trading stocks, because they're trying to find something hot. They don't know what they're buying. They just want to ride the momentum, they want to ride the wave and hopefully see a quick return. That way they can cash out for a profit. And you really start to see that shift when you see interest rates go up, because as interest rates go up, that's when investors want a bigger safe haven for their money, and they want to put their money where they can see more security, more stability, and real value. So now let's talk about how to value a company, because we talked about one way to value it. You can look at the number of users, multiply it by whatever dollar amount you want, which gives you a value. But a second, more kind of fundamental way of valuing a company is by looking at how much cash a company is making. So if I own a company, I started a company, and let's assume this company makes $1 million. how much is my company worth? Well, it depends what my company does. If it's a tech company, it's going to be worth more than if it's a retail company where I just sell clothes. So this is where you have to create the right valuation for how much this $1 million with the cash flow of profit that it's worth. Because if I were to sell this company, someone else, the investor, is going to want to put a price on the company. Some people might say, okay, well, this company is worth $10 million. That's a 10x multiple, which means $10 million. Others might say it's worth $30 million, depending on what type of revenue I'm getting. And others might say it's worth $100 million. So this is where now you have to come up with the right valuation and the right multiple for your company. A $1 million cash flow at a 100 multiple is worth $100 million. At a 30 multiple, it's $30 million. At a 10 multiple, it is $10 million. And so what we saw happen, especially in the tech boom that we saw in 2021, is tech companies saw insane valuations. They were seeing valuations at higher than 100 times earnings in some cases, meaning for every dollar that you earned, the valuation of a company went up by $100. This is, I mean, if you think about this financially, kind of hard to retrieve your money in this case unless you have significantly high growth here, because if I have to pay $100 million to make $1 million, well, it's going to take me 100 years to make my money back at this rate. You can make the number smaller to make it even more relatable. If somebody is making $1,000, you go out and you start a company, a lemonade stand, and you're making $1,000 in a year. Well, based off of the 100 multiple, you could sell that lemonade stand for 100 grand because over the year you made $1,000. You made less than $100 a month, and you can take this company that's making less than $100 a month and sell it for 100 grand. See, when you start to put it like that, you can start to see how absurd those valuations start to become. But the reason people have been buying in to these 100x multiples, or maybe even more than 100x multiples, is because they were hoping for fast growth here. They're hoping that they're going to turn this $1 million worth of cash flow to $2 million or $4 million or $10 million sometime in the near future. So people have been speculating because these tech companies were also able to borrow money super cheap. You can go out and borrow money for very low interest rates because mortgage rates, interest rates are at historical lows. This is one of the things that Warren Buffett looks at. He looks at the valuations of companies, he looks at the cash flows, and then he multiplies it by a number, and that's how you come up with the valuation of a company. And they have created something called a Buffett indicator, which kind of looks at the valuation of companies. And what we saw is that the Buffett indicator said that the stock market is more overvalued than ever. Business Insider says that Warren Buffett's go-to market gauge hit 211%, signaling that stocks are very expensive, they're overvalued, and that might mean a crash is coming. Yahoo Finance says that Warren Buffett's favorite stock market indicator still screams sell. The Buffett indicator focuses here on valuations of companies relative to how much money a company is making. This is what Warren Buffett likes to look at. He likes to look at the fundamentals of a company, and for him, it has worked over the long term. Well, in the short term, you can see major swings, where companies that are not making that much money could be valued insanely high because investors are speculating and hoping that this company will blow up sometime in the near future. Now, you can be right, or you can also be wrong. It's much easier to do that when interest rates are low because you have a lot of dollars floating around and these companies can borrow a whole bunch of money to try to accelerate their growth. But as you start to enter a time where interest rates start to rise, well, that's when more and more investors want to see this growth, not just the multiples of your company growth. This is one of the reasons why you're seeing a lot of hedge funds on Wall Street selling out of these tech stocks, these high valuation tech stocks, and they're rotating the money into lower valuation value stocks because they know that these value stocks are producing solid cash flows. They know that they'll be growing slowly, while tech stocks, they've been growing quickly in the past, but now that it's going to become more expensive to borrow money, and now that their debt is going to become a whole lot more expensive, they don't think that tech stocks are going to be able to grow as fast in the near future. That's why you're seeing that shift, and that's why you've been seeing a lot of tech stocks get hit hard because hedge funds are worried about that. Now, before you go out and sell all of your tech stocks, I need you to take a step back, take a deep breath. Now, think about what your goals are. Are you trying to be an investor or are you trying to be a trader? Because investors and traders have two completely different goals and two completely different mindsets. I'm an investor. I don't trade. When I buy a stock, I don't care what happens in the next 6 months or even the next 12 months. I want to hold on to it for the long term because I'm investing in a company that I believe in and something that I want to own for the long term. Statistically, you will make more money if you just hold on to your stocks for the long term because now you give your company more time to grow. Every company, every asset class is going to go through your ups and your downs. But if you believe in the company, it's producing real value, it's growing, well, you just got to give the stock time to grow with it. That's why you need to have a stock market strategy so you know what your goals are. You need to know what you're investing in, and that's why you want to have time in the market instead of trying to just time the market, because the people that try to time the market are usually the people that end up losing, because when it's going down, you keep thinking it's going to go down more, so you never end up buying, and then when it goes up, you think it's going to keep going up, and then you never sell, and so you buy too late, and you sell too early, or you sell too late as well. For most people, especially if you don't want to be in the business of trying to find the right stock and research stocks and do the type of fundamental analysis, the best thing that you can do is just follow a passive and automated financial investing system. That's where you have a few ETFs or index funds that you invest in, and then every time you get paid, a little bit of your money goes into your investments. Every time you get paid, whether the market is up or down, and you just let the system do its thing, because now you're just getting exposure to the market and you don't got to worry about all the swings. You're just letting the market do its thing. If you're looking for a platform to help you manage your money in the new year and you want to have something that can help you passively and automatically invest your money, then you should check out our sponsor, Wealthfront. I've talked about this before, but I have two ways that I invest my money. I have an active strategy and a passive strategy. My active strategy is much more involved, but my passive strategy is where I have money automatically being invested every week, and this money just gives me exposure to the market, and this happens every week whether the market is up or down. It is passive and it is automatic, and it will always continue to happen to give me exposure to the market. That's what Wealthfront can do for you. Wealthfront is a robo-advisor investment service that can do all of the investment legwork for you. They can manage your investments, and their software can help you build wealth because they can automate your investing, and plus they can also help you manage your risk and minimize your taxes. All you have to do is create an account, and then their software will build you a diversified portfolio. Or you can even pick what type of funds that you want to be invested in or what you want exposure to. Like if you want exposure to tech or healthcare or crypto. I like Wealthfront because they're completely transparent about what type of returns they've gotten. They're one of the few companies that do that, where they publicly disclose what type of historical returns that they've gotten. That way you can see what they've done in the past. And I know past returns don't always indicate future returns, but at least you can see what they've done. So if you're ready to passively and automatically invest your money in the new year, you can go to invest.wealthfront.com/minority-mindset to learn more and get started. And I'll also put the link for you in the description below. I forgot to mention the best part. Because you are a Minority Mindset fan, Wealthfront also has some special bonuses for you when you use our special link. So if you want to learn more and get started using our sponsor, Wealthfront, I'll put the link to where you can do that in the description below. The Federal Reserve Bank is in a tough situation right now. On one hand, we are battling some of the worst inflation that we've seen in 40 years. And on the second hand, if the Fed tries to raise interest rates to fight inflation, well then the whole economy slows down. We talked about this with tech stocks. If interest rates go up, well now everyone's debt becomes more expensive. Now, unless you have a fixed rate mortgage, it's not going to affect you. But for everybody else who doesn't have a fixed rate mortgage, like corporations who have debt which expires every few years, well, that means their debt is going to become more expensive. The United States national debt is going to become more expensive. All this debt that corporations, companies, people have that is not on a fixed rate is going to become more expensive, and it's going to become more expensive for corporations and businesses to go out and borrow more money. So we are in a state in the economy where everybody is reliant on this cheap money. And if interest rates go up, well, this money isn't so cheap then anymore. And that means a company and a person has to actually make money, has to actually produce value in order to be able to grow. Because right now, up until now, companies have been growing thanks to the help of cheap debt, cheap money. You can only grow because you can borrow money for free, but it's not sustainable. And what that's been causing is massive amounts of inflation. I mean, I've talked about inflation dozens of times on this channel and why it's such a big concern and why it is going to continue to become a concern. And so what that's doing is now it's putting the Fed in this tug of war, because now they're trying to just little bit raise interest rates. But they can't raise interest rates enough. The Fed says that they want to raise interest rates to something around 2% by the end of 2023. 2% interest rates. We're around 0% right now. Well, what you have to understand about that is if we're in an environment where you have 7% inflation And 2% interest rates, well, you're not going to be slowing down inflation. All you're doing is you're pouring less gasoline on the fire. You can't put out a fire by putting more gasoline on it. Even if it's less gasoline, you got to stop the gasoline and you need to put on some water. But the Fed can't do that. This is the tug of war. So if you're looking at really what this means for the long term, there's a good chance that the Fed is going to be having to do something more drastic in the next number of years in order to fight this inflation, unless this inflation can magically go away in 2022. You know, the Fed in 2021 came out and said that the inflation that we're seeing is not transitory. In 2021, they said it was transitory. They said that the only reason why we're seeing inflation is due to the supply chain shortages. It doesn't have anything to do with the money printing that we saw happen. Well, in late 2021, they started to change their messaging. They said that inflation is not transitory, the high inflation is permanent, but they did say that their goal is to bring inflation back down to 2% by the end of 2022. Now, I have a feeling, I could be wrong, but I have a feeling that the Fed is going to come out at the end of 2022 and they're going to say that they're wrong. And that's when more and more people are going to start to realize that the Fed is just lying. Because in order for the Fed to bring inflation back down, they're going to have to take more drastic measures on inflation. And that means they're going to have to raise interest rates more drastically to slow down the money printing, to slow down the influx of new dollars into the economy, to save the value of the dollar. Well, if they do that, that's going to put a big dent in the economy. So it's either do you see a dollar crisis or do you see an economic crisis? And if you do nothing to prevent either, well, then you're going to see a dollar crisis and an economic crisis at the exact same time. Because right now, let's assume that we keep interest rates super cheap. You keep interest rates low, you let the economy grow, you let these businesses boom. But then over time, what you're going to realize is the value of the dollar is just going to dwindle away. It's going to cost you $10 to get a bottle of water because the value of the dollar keeps going down, down, and down. But if you try to fight that, on the other hand, you want to save the value of the dollar, and now you start jacking up interest rates. Well, now the dollar is safe. The dollar still becomes a safe haven. It's still a strong currency. But then now you raise interest rates to the point where now businesses are struggling because all these businesses that have billions of dollars worth of debt, it's much more expensive for them to pay it off. They have to use a lot more of their cash flow to pay off their debt. They're struggling to grow quicker because they can't borrow money as cheap as they could before. So you see a big slowdown in the economy. You might see businesses lean out, meaning they might have to lay off employees. You could see unemployment rates go up, which means more and more people would struggle to pay their mortgages. You might see a rise in foreclosures. You could see a crash in the stock market. And so the Fed is trying to battle this right now. And the way that they're doing that is by doing nothing and just hoping the problem will go away. And so what are they doing? Well, the dollar is still fading away. We're still seeing very high inflation. And the economy is still going to struggle because they're just going to raise interest rates a little bit. So they're creating a bigger crisis by not doing anything and by just hoping that the problem will go away. And everybody says that this problem is going to magically disappear by the end of 2022. And I don't know how that can happen. I mean, maybe I could be wrong, but it's hard to understand how this problem can just magically go away when you have this inflation issue and you also have the economic issue where so many companies are reliant on the cheap debt. Now again, I can't predict what's going to happen. That's not my goal and that's not my strategy. When it comes to investing my money, I don't want to hold on to all of my cash because, well, then my money is going to be eaten away by inflation. And so that's why I invest my money. But I also don't want to just buy everything overpriced because then if the stock market crashes, then I'm the one that's holding on to the bag that gets cut in half. And so everything that I'm doing with my money is being more picky. Like I said before, I have an active strategy and I have a passive strategy. My passive strategy is going to continue to happen. I have my money that's passively being invested into things like stocks. I have some money that's passively being invested into cryptocurrency. I have some money that's passively being invested into physical gold. Then I also have my active strategy. My passive strategy happens whether the market's up or down. Doesn't matter. My active strategy is now where I'm actively investing my money into stocks. I'm actively investing into startups. I'm actively investing into real estate. So I'm actively looking for deals. But the only things that I'm actively buying are things that I believe are a good value, that I don't think that are overpriced, that I want to hold on to for the long term. Because the next decade is going to be a very strange decade. We're going to see a lot of changes in the economy in the next couple of years, and it's going to be interesting to see what the Federal Reserve Bank does to combat that. I'll show you what I mean. Here's a quick clip from the interview that I did with Peter Schiff.
What happens if you've got a weak economy and inflation at the same time? You can't cut and raise interest rates together. You can't have a loose money and a tight monetary policy simultaneously. So the Fed has got to pick its poison, right? Is it going to try to stimulate the economy, or is it going to try to fight inflation? Because it can't do both. And if it tries to stimulate the economy, the act of stimulating the economy will make the inflation problem even worse. So not only does it would the Fed ignore the inflation problem to try to stimulate the weak economy, but in doing, it would make the inflation problem even worse. So that's why it's the worst possible outcome for the Fed. It's the outcome that we have, and that's why they have to completely deny it exists.
So then how would you solve that? Because in the 70s, they had to really raise interest rates in the 80s to combat what we were seeing in the 70s.
Well, that's what Paul Volcker, the Fed ultimately decided in 1980 that it was going to fight inflation regardless of the impact it had on the economy and employment. So they took those type of decisive actions to fight inflation. That was their primary goal. Well, if the Fed were to do that, it would require a similar commitment to tight money. The problem is, when Volcker did it, the national debt was a small fraction of what it is today. Corporations and individuals had much less debt, and the nature of the debt was different. The U.S. government's national debt was financed with 30-year bonds. Now it's financed with one-year T-bills. So when Volcker raised interest rates up to 20% in 1980, it only impacted the new borrowing. It had no effect on the national debt. But if we were to raise interest rates now substantially, even 5 or 10%, for 20, but the entire $30 trillion national debt would be impacted. In fact, I think $10 trillion of the debt matures in the next year. So all that low interest rate debt would have to roll over in this higher interest rate environment. Back in 1980, nobody had an adjustable rate mortgage. They didn't exist. Now you've got a lot of people that have adjustable rate mortgages. Look at the credit card debt that we have now that we didn't have then. I mean, everybody, corporations have a lot of short-term debt. Look how much money they've borrowed to buy back their stock in a low interest rate environment. Well, when we move into a high interest rate environment, this is going to be a disaster. So if the Fed were to do what Volcker did and just fight inflation, regardless of the impact on the economy, it would be a far deeper recession than we had in 1980, 82. In fact, it would be a depression.
This is why it pays to be financially educated. That way you can make smart decisions with your money. That way you can come out of whatever happens a financial winner instead of a financial loser. What's up, everybody? If you want to continue building your financial education, here's a relevant video that I think you'll love. And as an added bonus, we put together a free guide that you can read on how to invest your money and build your wealth in the stock market. You can download and read the guide for free just by clicking that button below. When you hear people say things like the stock market is up or the stock market is down, what they usually mean is an index like the Dow Jones or the S&P 500 or the NASDAQ is up or down. So these are called indexes because they're essentially baskets or groups of stocks. The Dow Jones is a group of 30 very big companies.